Okay, we are live. So thank you very much for watching this episode of The Everyday Investor. I'm blessed to be in the company of two individuals here. Firstly, we have Ed McKnight, economist at Opes Partners. How are you, Ed?
Oh, so good, Darcy. Thanks for having us on.
You're welcome. Thanks for coming on. Thanks for inviting us into your bedroom. That's really cool.
Doesn't normally take much, normally 2 drinks.
We skipped that really painful
And for
process.
an easier access bedroom, it's Andrew Nicol.
So thanks, Ed. And we're also sitting in the studio here with Andrew Nicol, who is the managing director, both with Opes Partners, property investment company. Thanks for joining us.
Thanks for having us.
Cool. Okay,
my second debut for New Zealand Investor.
Yeah, that's right. I can't remember what number it was, but it was about 6 to 9 months ago, I guess we had on. It was a really good episode for those who want to know what is so special about property investment. In fact, I think that was the name of the episode, was what's so special about investing in property. So if you haven't listened to that one, check that one out. So today we're just going to cover off this question or this thesis. Has the property market crashed, or will the property market go through a correction or a crash of some sort? So you guys are in this all the time. I know daily you're doing a daily podcast, 10 to 15 minute daily podcast called The Property Academy. And so you cover little bite-sized topics on this all the time. So I know this isn't new for you to talk about this, but let me just ask you guys this question. Has or will the property market crash in New Zealand?
I'll jump in there if I can, Andrew.
Okay, sure.
The first thing is, there are 2 parts to it, really, in terms of a crash. One's in terms of prices, one's in terms of volumes. Now, it's really interesting. Some data just came out less than 7 days ago from the Real Estate Institute of New Zealand, which releases data about property prices. Now, this is for properties that settled in the month of March, so before lockdown, and these are properties that would have been signed and gone unconditional before the lockdown started. And what's interesting is, just as a starting point before the whole lockdown, was that the median New Zealand house price rocketed up to $650,000. Now, it only hit the 600s about 3 months ago. So I know that the month of February, the median New Zealand house price was $615K. March, $650K. So it increased by $35,000 in that month. So just in terms of prices, the latest data we've seen is that prices are very buoyant and healthy. Now, of course, the big question is, well, what's happening in April, in the April data? We don't know what's happening to prices right now, and we won't find out until the data is released about the 10th of May. But what we do know is that volumes will have crashed. The number of properties that are being signed will crash, and that's because properties generally cannot settle during this time, or it's being recommended that they're not going to settle. And Andrew can talk a little bit more about that in terms of what the Auckland District Law Society has suggested around that. But generally speaking, there are 2 parts to it. Volumes are going to crash. Prices, since the latest data, still healthy. We'll see how it changes.
Thanks.
So yeah, one of the main points there is around the value of properties or what they're being sold for. So one thing to remember is that there has to be a sale at a lower price for a price valuation to come down, and so then you require multiple property to sell at a lower price for the market to kind of come to a screaming halt or a crash, because we have to recognize properties as an average, and there will always be outliers. You'll always have some people who will, out of desperation, coming out of maybe a level 3 or a level 2, they might have a failed business, and so yes, they might sell a property at a lower rate, but they are going to be few and far between. And because the banks have been so generous with allowing these mortgage holidays, they're giving facilities which allow people to hold on to properties for maybe 6 or 12 months without making payments, or making interest only payments. I believe that there's going to be a lot of people who will maybe defer their mortgage payments in order to get their life back on track, or to get their businesses back on track. And so because those sales aren't coming through at a lower rate than what they might have been a month before, that's going to mean that people can hold tight, and so the market might not drop a lot. It might just go stagnant for a while, and so people will be able to weather the storm a lot easier than maybe if some of those products weren't available.
Gotcha. So that the key message there is that due to the fact that there's a lack of transactions that we can actually look at, it's not even really possible to say what's happened to the property market, because like you said, Ed, the volume just doesn't exist. So it doesn't matter what the price is because no transactions are occurring. So we're in this weird no man land. We're void of information, and it's just all speculation at this stage. But
Absolutely.
yeah, go ahead.
And sorry to jump in there. Just one other thing around that. So people, what we've seen in past times like the GFC, people tend to hold on to properties if the value goes down. And so again, even if the value goes down a little bit because some other people are selling at lower rates, doesn't mean that unless you're forced to sell, you're going to recognize or crystallize any of those losses. And so this is where this is probably the main reason why the market tends not to drop as much as economists tend to predict.
Okay. Yeah, and if you looked at any of the historical articles that were put out right after the GFC, a whole raft of economists were out there who were just calling it really, really wrong back then. They had no idea they were wrong at the time, but they were saying things like the property market will never, ever recover again. Pretty well-known economists, not you, Ed, but other economists.
Well, it's funny you should say that, Darcy, because I got a lot of heat about 4 weeks ago. I had an article published in Stuff where with the headline, "Economists Often Wrong, Economist Says," where I took a lot of that data and some of the Stuff articles from 2010 where I'd shown how top economists had said that the property market was going to decrease by 20% and would be depressed for a long time. And from that, I said, well, that article was written in January 2010, which was the lowest point in the property market. And actually, within 8 months, the market had recovered. The figures might be slightly wrong, date slightly wrong, but that was the gist of it. I got a lot of heat out of that. But that is the truth. Nobody can fully predict this. And as Tony Alexander, my favourite economist, says, nobody's ever come out with an accurate model to predict house prices.
Yeah. Well said. So let's talk about some of the negatives, some of the reasons, and there's a lot of articles out there and people who are putting out those headlines saying that the property market will be crashing are usually quoting some themes or some common things. So we'll call these the forces for evil, if you like. Let's start with the Airbnb dynamics. So do you want to just talk to us about how this would potentially work? All these people that have these Airbnb units that they're letting out on a short-term basis, converting them to long-term rentals, what impact that has. So Ed, do you want to just take me through that, how that could work?
Oh, this is one of my favorite topics, Darcy, because I think that the Airbnb effect is very concentrated in a few key areas. So there are 66 council districts all around New Zealand, and in 27 of those council districts, if all Airbnbs converted into rental properties, long-term residential tenancies, it would only add less than 4% stock onto the rental market. So let me just give you a bit of a sense around this. If every single whole home Airbnb, so the whole home that's let out on Airbnb, converted into a residential tenancy, it would only add 6.16% supply onto the rental market, 6.16%. I've crunched the numbers myself. There's about 33,000 whole home Airbnbs in New Zealand, which is about 70% of all Airbnbs, and there are about 590,000 rental properties. So that's how you get that 6.16%. But there are a small number of districts, about 10 districts, which have a high concentration of whole home Airbnbs. The most concentrated district is Mackenzie District in South Canterbury. Now, if in Mackenzie District the same thing happened, all those whole home Airbnbs converted over into residential tenancy properties, it would add 73 to 74% supply to the market. Queenstown's about 52, Thames Coromandel's about 51, Ruapehu, Tasman, all of those really tourism hotspots, they've got a high proportion of whole home Airbnb. So that's where it is most risky. Those are the areas that have the most risk of having a big Airbnb shock. Now, of course, the biggest one to think about is probably Queenstown, because you've got a lot of investors there who have bought properties for good yields. And as those start to disappear, as supply comes onto the rental market and renters leave Queenstown, because remember, at the moment, there are about 3,000 foreign nationals living in Queenstown for a population of about 15,000 anyway, who are probably going to want to go home or go elsewhere in order to find work, because tourism's got the guts kicked out of it down there. And so you're going to have not a lot of renters, you're going to have a lot of stock on the market, and a lot of investors who invested in Airbnb and took on very large mortgages in order to do so, but they could service it because of the higher income. That's where you've got a bigger risk to house prices if people are forced to sell because of those higher mortgages. So yes, the Airbnb shock is real. It will happen, but it will be concentrated in very specific areas. So we are talking about Thames, Coromandel, Queenstown, Lakes District, and Mackenzie are the top three that will be hardest hit. Places like Auckland, about 2.4% of Airbnbs make up 2.4% of the rental market if they all came on. And again, that's concentrated on Waiheke Island and Auckland, downtown Auckland. About 53% of Airbnbs, whole home Airbnbs, are in those two suburbs in Auckland, Waiheke and right in the middle of Auckland. Very few Airbnbs out in Manukau or West Auckland. So it is real, but it's concentrated in specific areas.
It's not a homogenous thing that we're making a comment on. This is very case by case. Okay, that's good. So tell me go ahead.
Just to add in there a little bit as well, with the stuff that's in, say, downtown Auckland, you'll probably find that a lot of that might be apartments, so they're not necessarily going to have a major impact on 3-bedroom or 4-bedroom houses in Auckland. So again, there might be some people that shift if they're in a 2-bedroom townhouse out a bit further out. They might move into town potentially. There might be some changing around there, but we don't see a major change in a very traditional house, which is probably more likely to be an Airbnb in Queenstown than it will be in Auckland, because more likely in the inner city you are getting an apartment.
Okay, awesome. Go ahead, Ed. You're going to say something.
And of course, there are two effects here. We're talking about one on the rental market, where it's going to have the biggest impact. If that comes across to have an impact on actual property prices, there are really only two effects. One, investors who are now forced to sell onto the market because they don't have the same yield. Again, that's going to be very, very concentrated. And then the other one, which is a really quite small impact, would be any first home buyers who are now tempted not to buy because they've got cheaper rents in those specific areas. So I don't anticipate the Airbnb effect is going to have that big of an impact on most of New Zealand's house prices. It's going to have a big impact on certain areas' rental market.
Okay. So then moving on to another thing that could affect or put downward pressure on the actual prices of property. Let's talk about the supply side, because we've been ramping up recently as much as possible. Developers are producing a lot more stock, and you guys are all over this, I know, in terms of who's doing what and producing what right now in terms of new stock that's coming to market. What effect is this going to have when these developers are probably dumping what the pre-existing stock is, and then there might be a bit of a quiet time where maybe some developers go to business? What do you see happening on the supply side of the equation?
So what I'm seeing at the moment with developers is they're a lot more favorable to a discounted price. So right now we're in the really sweet spot where they've had 4 weeks of not having any business, and it might be another couple of weeks before they get a whole lot of contracts. And so we're able to go out and try and negotiate maybe $10,000, $20,000 off a contract, in some cases up to $50,000 off a property in Auckland. So there is the desire from developers to do some more deals in the next month or so. Now that will be short-lived. That won't last forever, because they have got increased holding costs because they've had to hold and not construct in this period. But for most developers, there's probably not a huge amount of pressure for them, because banks require so much pre-sales before they start a development that nowadays that they tend to have most of the development sold before they even break ground. Certainly that would be true for most of our developers. If it was a single unit or single house development, it's typically sold prior to the fact that they even start with consents and anything like that. So the other thing to remember is, of course, there has been 5 weeks, or by the time level 3 kicks in, there's been 5 weeks with no construction. So that's all been come to a screaming halt. And so there's not going to be this massive influx of properties, because there aren't very many that are finished that aren't sold.
Okay, so let me put it another way. And again, I'm just trying to unpackage this force for evil a little bit more, the supply side bit. So is it paused or is it lost? Like, is there a risk that some of this new supply coming online is just paused and it'll recommence and it'll go faster just to kind of catch up to where it was? Or is it lost somehow? Do you know what I mean by that?
I think generally speaking, it's paused. Having said that, I know some Wellington developers, for example, major Wellington company, the largest Wellington company for development there, are reassessing a lot of their projects and probably not going to proceed with a few just to be cautious. So potentially that might have a supply issue there. But in saying that, if they get momentum in the coming couple of months, then they'll probably
Looks like we lost you there.
He might have just jumped out as well.
Those development.
Sorry, we just missed the
lost you there for a second.
Do you want to say that one more time?
Oh, sorry. So at the moment, there's companies who are basically reassessing their developments at the moment. So some of them have stopped, and they're not going to release new projects, so that will have a flow-on effect later. But having said that, if they get some momentum in existing projects, then I imagine, the developers, they make money from developing, they will want to get those other projects up and running as soon as they can, once there is a bit of momentum in the market again.
Yeah.
And just to add to that as well, if developers aren't able to make projects work and pull them from the market, bearing in mind that most of these houses aren't built, so they can't flood the market, that's actually going to be a force for good in terms of house prices, because you don't have as much new supply coming onto the market, so fewer houses has a slight inflationary impact in that side. So it depends how we go. I don't believe there are a lot of people who are out there looking to flog their houses because they have to. There are developers who need sales, but these houses actually haven't really hit the market yet.
Got it.
Absolutely.
Cool. And so we've talked now a little bit about the supply side, and in terms of new stock hitting the market or properties that are that need to be sold. And Andrew, you kind of touched on this a little bit before, because of the mortgage holidays, these deferment requests that the banks are dishing out because of the interest-only requests, because of interest rates at historical low. A lot of people don't actually have to put their property on the market, just like what happened post GFC. People didn't flood the market with their properties and get out. They didn't cash out because they didn't need to. A lot of them didn't need to. This time, it's a little bit different. But swapping over now to, I guess, the demand side, a lot of the demand is driven primarily by bank lending policy. And we're in an environment now where, interest rates are at historical lows. And so naturally, you start to think about some of the other dynamics going on here. Well, what would happen to some of the buyers that come to the market, maybe the first-time buyers, and they have a deposit that's provided by mom and dad? Will mom and dad be as willing as they were once before? What are your thoughts on that?
I think potentially that there's definitely going to be that conservativeness that hasn't been there quite the same in the coming months, because parents, particularly if they're using their equity to lend, or if they've got money in the stock market. So if they're taking money out of shares and they've taken an absolute pounding over the last wee while, they're going to be reluctant or more reluctant to give more money to the kids. Same is probably true for the likes of KiwiSaver. So a lot of first-time buyers use KiwiSaver as a part of their deposit, if not all of it. Now, if they're in a more aggressive fund, they've probably lost a lot of money, so their deposit might not be what it used to be. So there's probably a need for some time for that to recover, for them to have the deposit that they need to be able to go out and buy the property that they want now. So there'll definitely be an impact from that.
I think so. Yeah. Cool. And then in terms of lending policy, there's two layers here, right? So with the lending policy, it has been fairly restrictive, and I guess it doesn't matter how cheap the money is if you can't get it. But one of the spin-offs that we've only just seen announced today or flagged today is the Reserve Bank's willingness to consider removing these LVR restrictions. So Ed, perhaps do you want to just talk me through what that could look like? This isn't something that is definitely going to happen, but it's something that has been proposed. So do you want to talk to what that could actually result in?
If LVR restrictions are lifted?
Yeah.
Oh, look, I think this would add a significant amount of stimulus to the market. And Darcy, we actually just, about a couple of weeks ago, we released 3 scenarios, speculative scenarios, where we said, look, if the government changed X, Y, Z, how would that impact the property market? And look, the relaxation of LVRs would be massive. And that's specifically for investors. That's for 2 reasons. The first is that if the LVRs are relaxed, then investors need a lower deposit in order to purchase existing properties. So that means that the same amount of deposit can buy more property. That has one impact. But the secondary impact, which is just as important for investors, is that the way a lot of investors pull that deposit together is they will leverage off the equity they've got within their existing portfolio, the existing properties that they own. That's how they create the deposit. Now, the relaxation of LVRs means they can borrow more against their existing property portfolio. So now not only does their existing deposit allow them to buy more property, they've now got more deposit because they can borrow more against their properties. So whether you invest in new or existing properties, this is going to have a massive impact specifically for investors because you've got a bigger deposit and you can buy more with that deposit. It has a double impact. And so depending on the implementation of this, that's going to impact how much of an inflationary impact this has on the market. But I believe the article I wrote, I talked about a decrease from 30% LVR to 25%. It looks like, just from what I've read, it might be the whole LVR system may dissipate. So that would take it probably down to about 20%. That's going to have a massive stimulus. I can't remember the exact figure I said that would have it on the market, but it's going to be impactful.
It will. And I know. Go ahead. Sorry, Andrew. Yeah.
Oh, sorry. And then just one other thing that we covered off in that article was interest rates and the actual rate that the actual rates versus the test rate. So the test rate being the rate that the bank will use to test the servicing ability of your loan, and the actual rate, and the big disconnect between the two of those. And our other prediction is that we imagine that those test rates, the 7.5% that a bank is using to assess your serviceability, will come down. Now, if that happens, that too has a massive effect on the market. And I think that was the one that I expected to happen before LVR restrictions were eased. And so if that does come out next, then there is going to be a lot of pressure on the market, and there are going to be far more investors go out there. Plus, first home buyers are going to have the ability to spend more because all of a sudden they can borrow more money from the bank because their servicing says that they pass at a larger loan amount.
Yeah. Okay, so I guess you've got so many, like, you've got downward forces, right? We've talked about Airbnb. We didn't really talk about rising unemployment, but maybe before we move on to the positive side of the equation here, maybe just briefly, if one of you guys could just make a comment on what impact you speculate or you think the rising unemployment will have in terms of the property market, because obviously less income, people are less able to buy. Again, it might be one of those questions where it's not a homogenous impact. It's going to be different based on region. But do either one of you have any thoughts on how unemployment will affect the property prices?
I'll give some. Oh, you go ahead, Ed. Go ahead.
Sorry, Andrew. We always dive in. Hey, look, I just want to talk about, in terms of unemployment, the big thing I'm thinking now is about the rental market. So which then flows on for investors thinking about what they actually do with their properties. The big thing about the rental market is it is demand driven as opposed to supply driven. So if you have an increase in demand for rental properties, you see massive inflation, rental inflation. If you see a decrease in demand, you see massive drops in rent. And that's because suppliers, in terms of landlords, it's very hard to get in and then get out of the rental market in terms of either selling that property or turning it into something else. It takes time. So over the short term, the rental market is heavily driven by what happens with demand. So if we see unemployment get up to very high levels, like the most extreme of what Treasury has predicted, it's going to have a massive impact on the rental market. That's a bigger risk for landlords than the stock of Airbnbs. So we'll see what happens there, but it also depends, well, what's the ability for the rest of the labour market to pick up those employees? Because there are some industries like supermarkets who are doing extremely well out of this and are hiring like crazy. Same with Ministry of Social Development, hiring a lot of people to work on a lot of cases. So we may see there's a difference between short-term unemployment and long-term unemployment, and we'll see what those work out to be. The difficulty in this situation, Darcy, is that data takes a long time to actually come out and be released. It's only now in 2020 that the 2018 census data is actually being released, and we're looking at what was happening back in 2018. And so it's hard to comment on something that is evolving so quickly. We do have some forecasts from Treasury, but we don't have actual numbers about what it's actually turning out to be. And look, we don't necessarily know how businesses are going to react after being put on pause for 4 weeks. But what I would say is the biggest risk is actually in the rental market, which then has flow-on effects there into the actual property market. Obviously, in terms of people having little income and being forced to sell their properties, we kind of talked about that in terms of the mortgage holiday scheme, and we see that there is going to be less pressure than there was during the GFC, because if you lost your home during the GFC, you've still got to pay your mortgage. There are programs now where you don't have to, so you're a bit safer. There's more government assistance coming out that allows people to keep people employed. I'm involved with another business that employs lots of people, and we're keeping every single one of those people employed in the hospitality industry, actually, because of that government subsidy, and able to do that. So we're going to see once we get the data. But I'd say, look, the biggest risk is definitely in the rental market as opposed to the property market at the moment.
Yeah.
Andrew, and I think a big part of that will definitely be region specific as well. So somewhere like Queenstown is going to suffer a lot more unemployment than the likes of, say, Christchurch. And so you might see a shift of people going from Queenstown to Christchurch to get a job. And so that might put an upward pressure on the Christchurch market. The unemployment might have downward pressure in the Queenstown market because of that.
Yeah. Good answer. Okay, great. So let's talk now, like everything that we've talked about, right? We're trying to talk about these downward forces, but it's like a double-edged sword. There's always a counterbalance. And it seems like what we've covered so far, yep, there's these downward forces, but there's also a point where, because of other effects, like an entourage effect, that creates this floor of support where they're counterbalanced to a certain extent. So now let's go on the other side and talk about these upward forces. Surprising to talk about this, and we don't want to sound overly optimistic. We've got to acknowledge the fact that, yeah, it's pretty scary out there and there's a lot of uncertainty out there, but just because it's uncertain doesn't always mean that it's bad or it's wrong. It just means that we just don't know. So let's talk about some of the good things, and we've already touched on the fact that the Reserve Bank just today have announced that they're reconsidering the LVR regulations, and that hasn't yet gone through. They're proposing that, but let's talk about the lower interest rates. So this has already been happening, and with a surprise, well, sort of surprise-ish cut of the OCR down to 0.25 now, and the subsequent drop in a lot of the fixed rate loans, like 3.05 for a 1-year rate, is phenomenal. If you can get it, it's cheap. And it kind of touches on this theme that I'm aware of called the Cantillon Effect. I'm not quite sure if you guys are aware of that term, the Cantillon Effect? Or Cantillon?
Talk us through it.
Okay, well, for what I know, and I've only just read a little bit about this, is that the theory goes, it was, I can't remember the guy's first name, I don't know if it was Richard or something like that, but in the late 1800s or something like that, I could be completely wrong with all this, by the way, but he put this theory out there that when there's an increase in the money supply, it should have an inflationary impact, but because of the people that are first in line to benefit from that money creation, it actually creates asset bubbles. So before it gets to those who really need it, like the everyday consumer, it usually starts with those higher up in that pyramid structure, those who are already wealthy, and it has the effect of increasing asset prices. So the theory is the more money that you generate, the higher asset prices go. And you know, if you watch what's happened in equity markets, sharp sell-off, sharp recovery as at today. And that's a clear example of how when you create more money, when you inject more money into a system, it inflates asset prices. This happens in the property market. As interest rates have gone down over time, we've seen prices just continue to go up and up and up. So as a floor support or even a force to actually increase property prices, what do you think of that? Do you think that as interest rates drop, is it reasonable to speculate that we could actually see house prices increase after we're out of lockdown? What do you think of that?
So I definitely think there is going to be some demand for areas that people couldn't get into because it was unaffordable previously. So, for example, Auckland is a great property market, which all of a sudden in the last few months, you're able to buy a property there even with 100% borrowing, even using your usable equity as your deposit, so not putting any cash in, and your top up per week, allowing for all expenses, is modest. And when I say modest, I mean like under $50. So, a couple of years ago, I would have told someone they need to budget for sort of $300 a week top up to buy a property in Auckland, the 100% borrowing. Today, it's like $38. So I think that is going to absolutely mean that more investors look there. So I've got probably 3 clients at the moment in Wellington who never would have looked at Auckland because it was too expensive, all of a sudden it's cheap. It's not just affordable, it's cheap. And so people are actually going to go in there and start investing. And then you look at somewhere that's cheap, like Christchurch, for example, or Hamilton, and you can buy a property and it pays for itself. And so all of a sudden you're creating a lot of demand for more rental properties because people know that this is a short-term blip. And even if it took 3 years to recover, if you're not having to top up your investment for 3 years, doesn't really matter how it performs so long as you get into that market and you actually secure a good price. Now, I think it will recover a lot faster and you'll actually see some upward pressure, particularly in those affordable markets and in the Auckland market, because people can now afford to get into a market where they previously couldn't.
Good point. So that it's
I'm
not
going to jump in there as well to talk about the money supply. This is really interesting because the other side of interest rates, the Reserve Bank's come out, announced the large-scale asset program. Now, what is this? This is where the Reserve Bank comes and says, we're going to buy up all the government bonds. We're going to buy up all the government bonds, and we're going to push down the interest rate that investors can get on government bonds. So they come in, buy it all up. And that means that any investors who were going to go and buy government bonds now can't buy government bonds. So what do? This is how the money supply actually works, is that now investors have got money that they've got to go and do something with. And so what are they going to do? They've got to go invest somewhere else. Now, this is one of the reasons, and you just brought up the article before, that I think property could do really well, is because interest rates are so low, the share market's in flux, there are a lack of other opportunities to invest and a lack of other stable asset classes that investors can go and use that money on, especially now that the Reserve Bank's has announced they're going to go out and buy bonds from the councils and local governments. So there's a lack of alternative investments. And now the interesting thing about the decrease in interest rates is that, number one, it makes term deposits less profitable, but it makes property more profitable as a cash asset, as an income generator. And that's because the biggest expense in an investment property is the cost of the mortgage. Now, if that goes down by 20% or 15% because the interest rates decrease from 3.5% to 3%, that has a significant impact to the cash you can pull out of a property. And I think the blog you pulled up, the article I wrote, showed how it increased the cash out of it by something like 2%. And it showed how property as a cash generator now can get a better return than term deposits, which wasn't the case previously. Before the interest rate cut, that wasn't the case. So any investors who now were going to invest in government bonds can come into the property market, get a better cash return than what they were otherwise going to get, and get the capital gain as well. So it's really interesting. Once you start to dig into the numbers, because all the other asset classes have either been crowded out by the Reserve Bank or are in flux, like the share market, there are a lack of alternative investments. So the decision is either accept the subpar interest rate from the government, or do something else with that money. And in this case, we were looking at what property could do and showing how it can get a better return.
Correct. Yeah, that's a good point. And it's this whole theme, as interest rates go down, there's this hunt for yield. The conservative investor is forced to go up a little bit, aren't they? They're forced to get away from cash, forced to get away from fixed interest, and now they're entering more into property. And those that are in property are getting more into, say, commercial property, and then they're getting more into equities. Those that are in equities seem to be going more into alternatives. So it's this hunt for yield, and it has this interesting ripple effect. As interest rates get lowered, it's just phenomenal, because it just affects everything. Fascinating stuff. So let's talk briefly now about New Zealand as a safe haven, because I've often said this, that New Zealand, honestly, and this is coming from, I wasn't born in New Zealand, but I am a Kiwi. New Zealand is absolutely the best place in the world to live. If you've traveled, you understand this. Or if you've come from somewhere else, you really understand this. The rest of the world is absolutely waking up to this. What do you think, and think about the response that our government has had, being proactive in handling this pandemic. What do you think what impact do you think that will have to New Zealand, in terms of its attractiveness to people who might want to own a slice of the action? Ed?
Andrew, do you want to talk about the expats that we've been talking about recently?
Yeah, so we've actually been dealing with a lot of expats, and so part of this, because potentially New Zealand is familiar to them, and now they're thinking, actually we maybe we maybe will just come back to New Zealand a little bit sooner than we originally thought. Some of those people are looking at investing in New Zealand now. You've got our government has done an excellent job at dealing with coronavirus in such a swift and confident manner, and so that does give a lot of confidence to invest, and both here and overseas. And of course, whilst we might not have a lot of people coming into the country in the next wee while if the borders remain shut, you also don't have people leaving either, and so people might want to settle down here, actually get their roots into New Zealand. They might not be planning on moving to Australia. Like I was talking to one of my investors today who was planning to move overseas at the end of the year. She's deferred that decision for another year, and so she's probably going to look at buying a house for herself here as well as an investment. And so all of a sudden people's plans are changing, and they're thinking, okay, well, maybe we'll just keep our investments and my cash here. She was an investor actually with quite a lot of shares as well, so she's taken a hit there, decided property might be a much more stable investment for her, and so rather than buying one property, she's looking at buying two. So that change of mentality is going to create a bit of demand as well.
Nice.
You make a fair point as well around specifically wealthier individuals coming to New Zealand, because although I don't expect hordes of them to be coming to New Zealand, it doesn't take that many wealthy individuals to have a substantial impact on the property market. Because if you own a 2-bedroom apartment, a reasonably nice one in Shanghai that's worth a couple of million, you sell that, move over to New Zealand, well, hey, you can get a really nice place, and you're not as price sensitive. You can buy all of Christchurch, but you can get a lot for your money's worth when people move from really hot property markets over here. Now, if they come in, throw their cash around a bit and overspend, quote unquote, overspend on a property, that means that the New Zealander that just owned that property, now they're feeling really good. They're going to go buy something good. And so it has this ripple effect of people feeling really confident. This is why Bay of Plenty, or Tauranga in particular, has got really hot. Tauranga is, in terms of where it sits versus the long term over the last 27 years, it's sitting really, really high. Prices there are higher than they typically have been over the longer term. Why? Because Aucklanders feeling really good about the purchase price or sale price they've been able to get for their property, move down there and are able to spend up a little bit, are able to buy nicer properties, are able to spend a little bit more or outcompete the next person. And so property prices go up there. And so you have a similar effect if people from overseas come over here, spend up a little bit, overpay a little bit. Now everybody's feeling good, and that kind of trickles down to other homeowners as they sell their property. So it doesn't take a lot of very wealthy internationals to come here and have a substantial impact on the property market.
And do you think that's also a double-edged sword, though, like just to play devil's advocate a little bit? Because like you mentioned Bay of Plenty, effectively it's a derivative of Auckland. And so, Queenstown, let's speculate, maybe that's a derivative of wealthy individuals overseas. Who knows, right? It could go both ways, couldn't it? But it would go as a function of what's happening somewhere else, right?
Yeah, you're right. You go, Andrew.
You go. I certainly do think so. Again, there is always that regional difference, and you have places like Queenstown where absolutely there's a lot of international money there. But then you've got your areas like Auckland where realistically they're much more stable or tried and true from an investment standpoint and a value standpoint.
Yeah, cool.
Yeah, and in Auckland in particular, you've got so much of a diversified economy, a much more diverse, a much stronger economy as well. Everybody on our webinars that we do and podcasts and things, everybody wants to know about Wanaka and Queenstown. The thing is, those two areas are just such special cases because you've got a lot of international interest there, a lot of tourism, a lot of money going straight in there, but you've got very small populations. The economy is not that robust down there, and so that's where it is going to be most impacted. How big that impact will be, we don't quite know, but it is going to be big. But that doesn't necessarily extend to the whole property market.
Correct. That's good. Good points that you guys have raised so far. Like this has been awesome. Thanks for helping me understand it a little bit better, because you guys deal everywhere in New Zealand. and you're dealing with property investors that might be first-time property investors, or they're building a portfolio. They've already been there and done that, and you're helping them with the next step. So just for the benefit of our viewers and our listeners, can you just tell us a little bit about what Opes Partners does, just so that we have a clear understanding on what people could do if they want to take this a little bit further, especially during this time? So you mentioned like
do you want me to cover that one, or are you going to cover that one? We're both sitting still waiting for the other one this time.
I was waiting for you to do it, Andrew. I thought you might have frozen.
I was about to dive in, but I was too worried about being cut off again. I'll start and then you can finish. How about that? So Opes Partners is a investment property coaching program. So we coach people on how to make smart investment decisions in the property market, and we do that via our podcast. We do it via online training. We do it via face-to-face training when we're allowed to do that, and we make it really easy for people to make informed property investment decisions, and it is the easy way to become a property investor, a successful property investor in New Zealand. Ed, do you want to add anything there?
Yeah. So we've fine-tuned our process over many years, Darcy, to make it as robust as possible. And the big thing that we identified was that it's the thing about property investment is it's very little to do with the property. It's all about the investment, to making sure the numbers stack up. And then, of course, having the right property that actually does stand up, literally. And so what we do is we help people put together an investment strategy, something that's going to achieve their goals, find out their goals, and say, look, this is what you can do. This is what you should do in order to achieve your long-term financial goals. And then we go out and we find the properties that fit within those strategies. So Andrew in particular is scouring the market all the time to say, well, where are the best investment opportunities? And then we go, we talk to the vendors, we get that stock, and then we can recommend it to our clients. So that's how it works. It's really strategic. And hey, every time I explain, I think, God, this is a good thing.
And you're not biased.
You know what I mean?
Yeah, you're not biased in the slightest way. But and the thing is that it's things like what you mentioned before about Wanaka and Queenstown, and just being aware of the fact that there's not necessarily a lot of diversification in terms of the industry down there. Like presumably when you're scouting out these areas and you're trying to figure out what areas would be great for property investors, you're factoring in not just what does it rent out for and when was it built. You're actually thinking about so much more, aren't you?
Correct. So we did a lot of seminars in Queenstown last year, and part of the message of that, and certainly to our clients afterwards, was you need to diversify outside of Queenstown. And it's really hard for people who are in Queenstown, especially if they've been investing in Queenstown, to think outside of Queenstown because the returns have been so good. The values have been going up and the yields are so high, they don't have to contribute to an investment. And so in their mind, it was a no-brainer. And I've actively discouraged people from investing there because it's a one-trick pony. It is a region which is so reliant on tourism that I think it makes a very risky investment. And so we've tried to offer alternatives. Now, I've got investors there at the moment that are just so happy that they have taken that advice and invest elsewhere. And because we're a nationwide company dealing with clients everywhere, we're also dealing with properties everywhere. So you're not limited to where you live. Again, a client of mine that I'm dealing with in the Hawke's Bay at the moment, they specifically wanted to invest out of Hawke's Bay. And so we're able to offer a solution. So not only can they make a good investment decision on what they're buying and what their structure is, but they can have access to properties that they wouldn't have access to otherwise because we've through using our program. And also we offer an end-to-end solution, so we don't set people up and say good luck with that in 20 years when you want to sell it. We actually offer the full property management solution. We help people with the accounting solution, and we are there at the end when they do decide to sell it through our real estate company.
Yeah. No, that's fantastic. That's good. Well, Ed, thanks for joining me on this episode, and really appreciate the work that you guys are doing. I've got quite a few of my clients that have actually used you guys now to source and set up investment properties for them. You deal primarily with brand new stock. I think you deal exclusively with brand new stock. So yes. If you're into that, then I'd encourage you guys just to check out, or encourage our listeners to check out Opes Partners. And hook into the podcast as well. So we haven't really plugged this yet, but let's mention the podcast here. So the Property Academy, where can they go to find the Property Academy podcast?
So you can find that on all the standard podcast listening platforms. We're on, of course, on Apple, Spotify, Google Podcasts, Castbox. I know there's a devoted following on Castbox. I didn't know until I went to a seminar and somebody said, I listened to your podcast on Castbox. I thought, what the hell is Castbox? But it's on there. I don't know what it is, but it's on there. And we do a daily show. Every single day we release a 10 to 15 minute episode about the podcast, about the property market. And the real benefit of that is that we have to dig deep very, very quickly into one specific topic, cover it all off, and then we wrap it up and it's done. So it's got a really nice fast pace. And look, Darcy, we're going to have you on the show sometime as well.
Yeah, definitely. Let's do it, man. Let's do it. So, thank you very much, because the last time, that we had you on the show, Andrew, I just had a look here. It was episode 28. So it's quite a few episodes for me a while ago. So I think, let me get onto your show as well, and I'll spout out a whole bunch of controversial stuff as well, just to mix it up.
Good. We love that. We love controversial.
That's awesome. Well, thanks again for showing up.
Thank you for having us.
All right. Take care, guys. Cool. See ya. All right. That has ended.